Welcome to this week's episode of Jonathan on Money. This is episode number 175. So it's the last weeks of August, which means it's time for the Shenkman family road trip. And this year, we're headed up to the Pacific Northwest, where we're going to be in Oregon and Northern California. I'll share a recap of the trip and my itinerary in the next upcoming episode, and I'll be sure to share all the details for listeners then. In other news, don't forget to buy my book, D's for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanmoney.com. And buying this book is still a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live fall webinar series is now finally released. Our first event is on Thursday, September 10th at 8:30 a.m., featuring K. Eli Akhavan from the law firm Grant, Herman, Schwartz, and Klinger, based in New York City. And he's going to be speaking about New York City pied a terre surcharge and what advisors need to know. I'm sure I mispronounced that, but people know what I'm talking about because it was in the news quite a bit over the past few weeks. I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will discuss finances and Shalom Bayit, 10 reasons why couples fight about money. Our quote this week is from Jerry Seinfeld on choosing the torture you can deal with. I'll spend the last half of the episode answering listener questions, including investing in business development companies. And finally, we'll end with an actionable idea to implement to your investing life, where we'll discuss avoiding pulling money from the wrong accounts first. And with that, let's jump into this week's talking points. So I received the following question recently, which went as follows. My spouse and I see the world in the same way on most things. We share values, life goals, and a vision for the kind of home we want to build. Yet, when it comes to personal finance, we sometimes find ourselves on opposite sides of the conversation. It may be about how much support to give our adult children, whether we should downsize, or how to balance present comfort with long-term security. At times, it feels like these differences are pulling us apart. Do you have any guidance on balancing money and Shalom Bayit? So these disagreements are not unusual. Money is one of the most common sources of friction in marriage, and it naturally intersects with Shalom Bayit, which is the peace and harmony of a home, in very real ways. Financial decisions are never just about dollars. They reflect identity, values, fears, and hopes, as well as the emotional wiring each spouse brings into the relationship. When couples recognize this, they can begin to approach money not as a battlefield, but as a shared mission. In my experience, Shalom Bayit comes down to three pillars: transparency, alignment, and respect. The following 10 common financial themes I'm going to discuss highlight how financial choices shape the emotional climate of a marriage, and how thoughtful communication can turn potential conflicts into partnership. First, budgeting. Budgeting is often the first place where respect or control shows up. When one spouse unilaterally controls spending or scrutinizes every purchase, even with good intentions, it can feel demeaning and lead to resentment. For example, if one spouse reviews the credit card bill every month and constantly criticizes the other spouse's spending, the issue is no longer about cash flow, but about respect. When a couple builds a financial plan together, both partners feel heard. One may prioritize saving while the other values spending that enhances daily life. The process itself strengthens trust. It's worth going through the financial planning process to bring both spouses on the same page. Two is investing. Investing introduces emotional complexity. One spouse may prefer aggressive growth strategies while the other leans towards stability and preservation. If these differences are not addressed, market downturn can trigger anxiety, blame, or I told you so moments. A healthier approach is to adopt a strategy both partners can live with emotionally. The mathematically optimal portfolio is irrelevant if it creates stress or conflict. Peace of mind and the ability to stick with a strategy are even more important than performance. For example, if one spouse is comfortable with 80% of their money in stocks while the other cannot tolerate market volatility, compromising by reducing exposure to 60% on and increasing bonds and cash exposure can ease tension and still allow the couple to achieve their goals. Three is spending. Hidden spending is one of the most damaging breaches of trust in a marriage. Secret credit cards, undisclosed debt, or concealed financial losses often hurt more than the mistake itself. Transparency is essential. Couples can usually recover from financial missteps, but secrecy undermines the foundation of the relationship. Shalom Bayit is built on honesty, not perfection. Both spouses should understand the full financial picture. Keep one partner in the dark about finances will never end well. Four is lifestyle creep. As income grows, so do choices. One spouse may want to upgrade homes, cars, or vacations, while the other prefers to save more, give more, or reduce work hours. This disagreement, these disagreements are rarely about the purchases themselves. They reflect deeper questions about what money is meant to accomplish. Is it for comfort, status, freedom, or spiritual purpose? A conversation about each spouse's ideal lifestyle can clarify what is truly important and help minimize spending in areas that bring little satisfaction. Five's career and income decisions. Supporting a spouse's career ambition can be both inspiring and stressful. One partner may want to start a business or pursue a meaningful but lower paying path, while the other prioritizes stability. This requires balancing belief in your partner with responsibility to the household. A way to alleviate this tension is by having a written business and or career plan. For example, if a husband plans to learn in Kollel for 7 years while his wife supports a family, it is helpful to define how he will transition into earning a living afterwards. Taking college classes or gaining work experience while in Kollel may reduce uncertainty for the other spouse. Similarly, if a spouse wants to leave a stable job to start a business, creating a plan with a defined time frame and a fallback option can provide clarity and reduce stress. Number six is goals. Even couples who share core values may have different long term goals. One may want to retire near their children in the United States, while the other dreams of moving to Israel. These differences require compromise. Alignment does not mean identical thinking, it means finding a direction that both partners can support, perhaps a long term rental in the US and committing to returning for certain holidays every year, can address these concerns. Seven is charity. Decisions about giving tzedakah can be complex. Couples may differ on how much to give or which causes to support. This is further complicated if there is a struggling family member who needs financial support. Developing a hierarchy for giving tzedakah may help. Many from families that I work with have their own list of charities that they give to every year. It takes time to develop a list of causes that are important to you, but once completed, it can minimize disagreement and make your philanthropy more impactful. Eight is unrealistic expectations. Financial expectations can create significant strain. One common issue is expanding a lifestyle that the couple cannot afford, including vacations, upgrades, and ongoing discretionary spending. Tension can also arise when one spouse expects unlimited financial support from family or one spouse wants to financially support other family members without considering its impact on the household. Healthy marriages require realistic assumptions about and shared responsibility for lifestyle choices. Sitting down together and reviewing the numbers, i.e., income versus expenses, is imperative. If the math doesn't work, expectations need to change. No one gets a pass on math. A nine is time versus money trade offs. One spouse may work long hours to maximize income, believing this is the best way to support the family, while the other prioritizes time at home and emotional presence. This is not a disagreement about work ethic, but about values. I work with many clients where one spouse works 70 to 80 hour weeks every week, while the other spouse manages the home, including carpool pickups and extracurricular activities. Some couples choose to scale back their lifestyle to gain more time together. Others prioritize financial flexibility and accept longer work hours. There's no single correct answer, but there are always choices about how time is spent. Discuss these choices and whether they will improve your life. And finally, number 10, financial decision making style. Some couples prefer to make every decision together, while others divide responsibilities. One spouse may handle investments, while the other manages day to day expenses. All permutations of shared responsibility are fine. However, problems arise when one partner feels uninformed or when Others feel micromanaged. The healthiest approach blends autonomy with transparency so that both partners remain informed and respected. I'd like to conclude by pointing out that personal finance is an art, not a science. Effective financial planning is not only about numbers. In marriage, flexibility is essential. Maintaining Shalom Bayit often requires compromise. When spouses disagree about major decisions, creative solutions can preserve both harmony and financial progress. If one spouse wants to downsize immediately and the other is not ready, a gradual plan over several years allows the movement towards the goal without giving the family while giving the family time to adjust. And relocating right away may be more financially efficient, but life does not always follow the most optimal path. Similarly, if one spouse wants to continue supporting adult children, a structured plan that reduces assistance over time balances generosity with long term responsibility. It may not be the perfect method for encouraging independence, but it respects both partners' concern. Lifestyle differences also require nuance. While one spouse values certain luxuries, focusing on a single discretionary area while maintaining discipline elsewhere can protect financial stability without dismissing personal preferences. These kinds of compromises help couples honor each other's priorities while staying aligned with their broader financial goals. A financial advisor can help clarify strategies, but not every challenge is purely financial. Money is closely tied to emotions, communication, and relationship dynamics. In situations where deeper patterns are involved, working with a qualified therapist can strengthen both the financial plan and the marriage itself. The bottom line, strong finances do not automatically create shalom bayit, but poor communication around money almost always creates tension. The healthiest couples treat money as a shared project that requires emotional awareness, curiosity, and respect. When spouses approach financial decisions as partners rather than adversaries, they strengthen both their financial future and the peace and harmony of their home. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter, still free, at parkbridgewealth.com/newsletter. This week's quote is from Jerry Seinfeld. For those who don't know, Jerry Seinfeld is an American comedian, actor, writer, and producer. Best known for co-creating and starring in Seinfeld, one of the most influential sitcoms in television history. It's still the only show I have the patience to watch and actually think is funny. He grew up in Massapequa, Long Island, just a short drive from where I live, and he built his career on sharp observational humor, turning everyday moments into comedy. After Seinfeld, he continued performing stand-up, created the series of Comedians in Cars Getting Coffee, and became a cultural icon for his clean, precise comedic style. His work helped redefine modern comedy and remains widely celebrated. And Seinfeld once said, "Your blessing in life is when you find the torture you're comfortable with." The quote is really saying your life gets better when you choose the hard thing you're willing to endure because it leads somewhere meaningful. Everyone suffers. The difference is whether the suffering is aimless or purposeful. Seinfeld went on to explain that daily work, marriage, raising kids, and exercise are difficult, but success comes from choosing the specific struggle you can happily endure. Investing works the same way. Every strategy involves discomfort, whether it's market volatility, saving aggressively, staying disciplined during downturns, or locking money into illiquid assets. The investors who thrive aren't the ones who avoid pain, but the ones who pick the right kind of discomfort and stick with it. Finding your comfortable torture means choosing the challenges that align with temperament and long term goals, allowing compounding and discipline to work in your favor. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and maybe answer in a future episode. Okay, first question. How will the war with Iran impact my finances? The topic is obviously getting a lot of airtime on the news, but practically, what should I know? So, since 1940, when the Germans invaded France, through every market shock geopolitical event that followed, the market is higher 46% of the time a month after the event, 66% 3 months after the event, 61% 6 months after the event, and 65% the year after the event. These are all short term numbers, which are pretty compelling. However, if you're truly an investor, then the short term should not be something you spend too much time thinking about. The latest news headlines, wars, and geopolitical events are small, irrelevant speed bumps along the way. As long as you have a sensibly structured portfolio based on your goals and time horizon, I would not stress yourself over the current war with Iran. The only short term financial factor that will actually impact your life is a spike in oil prices as Iran cuts off passage through the Strait of Hormuz. As much as I like saying the word Hormuz, I don't think it will be a long term concern. As I say often, the news outlets are in the business to get more clicks and eyeballs. Negativity sells. While this war is a big deal, the news channels are in the business of getting people more riled up than necessary so they get nervous, keep watching, and generate more ad revenue for their parent companies. As an investor, I would not be overly concerned with my portfolio or elevated cost of gas prices. It will pass quicker than you think, and we will be on to the next war, scandal, geopolitical event, etc. As a practical tip, I'd consider consuming less news, especially Tucker Carlson, who should be blocked, unfollowed, and reported for libel immediately. Next question. My uncle is very successful in lending money in real estate companies. He told me he keeps all his safe money, about low eight figures as he described it, in BDCs. What are these things and what are your thoughts on the strategy? It sounds to me like your uncle is clueless, but we'll get back to that in a minute. But first, by way of background, a business development company, or BDC, is an investment vehicle that provides financing to small and mid-sized U.S. businesses that may not have easy access to traditional funding. The way it works is BDCs raise capital by issuing shares and invest that money primarily through loans, equity stakes, or hybrid structures to private or smaller public companies, while often also offering managerial support to help those firms grow. To maintain their status as regulated investment companies, BDCs must distribute at least 90% of their taxable income to shareholders, which often leads to relatively high dividend yields and attracts income oriented investors seeking exposure to the private credit market. However, despite these potential benefits, BDCs carry many risks, including volatility, credit risk, leverage, and the difficulty of valuing or exiting private investments, making them similar in many ways to publicly traded private credit funds with both attractive income potential and meaningful complexity. The reason why your uncle is clueless is because one, he's concentrating his assets in one area of the market. Two, he's concentrating his funds in a very risky area of the market. And three, safe money, whatever that means as you described it, should not be concentrated in one risky area of the market. Dumb, dumb, dumb. This is a good reminder that success in one area of life, wherever your uncle made his fortune, does not necessarily carry into other areas. I make a point of telling this to arrogant doctors who try to convince me they are savvy investors. They don't seem to care for my candor. Tell your uncle he would benefit from hiring someone who has experience in investing to help him. What's the difference between current yield and yield to maturity? My broker at one firm pushed current yield, which is higher than my other broker who's only quoting yield to maturity. So current yield measures bonds' annual coupon income relative to its current market price, giving a snapshot of the income as investors receive today, but ignoring any gain or loss when the bond matures. On the other hand, yield to maturity reflects the bond's total expected return if held until maturity, incorporating all coupon payments, the difference between the purchase price and the face value, and the timing of every cash flow. Since it captures both income and price appreciation or depreciation, yield to maturity provides a more complete picture of long-term return, while current yield is useful mainly for comparing the immediate income generated for different bonds. Without knowing exactly what you're looking to accomplish, yield to maturity is typically a much more accurate measure of return on your bond investment. So you should ditch the other broker, consolidate your assets with the honest dude, and simplify your life. What's credit risk exactly? I was discussing my private credit portfolio, which makes up most of my investments, and financial advisor asked me about credit risk involved. I said that there is none, but didn't actually know what he was talking about. Yeah, it doesn't sound like you know what you're talking about, kind of like most people who invest in private credit, which is sad. When you said your private credit has no credit risk, it was also pretty clear to the financial advisor and everyone else in that room that you are clueless. No worries, happy to help so you don't embarrass yourself at any future kiddish club gatherings. So, credit risk is the possibility that a borrower will fail to repay a loan or meet the terms of a financial obligation, creating a lending and it. Let me back up. A financial obligation creating a potential loss for the lender, i.e., the investor, and it arises every form of lending and reflects the borrower's overall ability and willingness to repay. Lenders evaluate this risk by examining factors such as credit history, financial stability, collateral, and broader economic conditions. A higher level of credit risk typically leads to higher interest rates to compensate for the increased chance of default. Bekitzer, if you have attractive interest rates on your bond like investments, it usually means there is a higher risk of default, i.e., losing your money. This is a concept that you should familiarize yourself with if you are an investor in private credit. Next question. Given the crash in tech stocks due to AI, do you think technology stocks are doomed to failure given the AI trend? Probably not. I mean, there are certainly companies that will be phased out of existence if they don't adapt to the new AI revolution. But this is no different with every new wave of technology. Those who adapt to new technology and new realities thrive while others die. The AI revolution is just the latest evolution in technology. The theme for success is the ability to adapt. This is not only true with companies, it is also true on the individual level. Throughout my career, I have met people in my field, accountants, lawyers, and others, who are married to a certain way of doing things and never progressed. Inevitably, they slowly found their business deteriorating as it became obsolete. New technology shouldn't scare you. You should embrace it or hire people that can embrace it for you. At the end of the day, it's imperative to keep this truth in mind. Adapt or die. Are you concerned with stagflation giving rising oil prices and high unemployment? No, I'm not concerned. First, for those who may not be familiar, stagflation occurs when an economy is experiencing the mix of slow growth, high unemployment, and rising prices all at the same time. This became a major concern after the 1970s due to the oil embargoes, which increased production costs, reducing output while driving up prices. Stagflation is difficult to fix because policies that fight inflation often hurt growth, and policies that boost growth worsen inflation. This is relevant in 2026 due to tariffs, issues, oil supply, monetary policy mistakes, etc. The reason why this doesn't concern me is because one, everything moves in cycles, and two, a system of checks and balances. Ultimately, the economic dynamics that may be favorable for stagflation will change. Additionally, policy will change based on who's in office. But let's take a step back. Rather than stressing over the broad economy, instead focus on what you personally need to do to be successful. I come back to this theme often, but there are so many distractions out there that it causes folks to lose focus on what is actually important. You are not an economist working for the government that needs to decide policy response to potential stagflation, so chill the heck out. You're just a person trying to afford their lifestyle. In such a situation, your energy should be on making sure your income streams are resilient and your skill set is fresh so you can afford potentially higher prices and remain employed through any rough economic stretches. In the meantime, you can blame the Yidden for all the world's problems. There's That's also a key part of any cycle, by the way. Things are good, then they get bad. Blame the Jews. Eventually, things will get better. Everything moves in cycles. Next question. What's the difference between cash equivalents versus notes versus bonds, and where should I use each? What a delicious question. Cash equivalents are very short term, highly liquid investments such as treasury bills, money market funds, and short term CDs that typically mature in less than a year, usually within 30 to 90 days. They are primarily used for emergency reserves, short term spending needs, or temporarily parking cash while earning modest interest, and they help reduce overall risk to your financial life by giving you a cushion for big expenses or bad market environment. Due to their stability and liquidity, they carry the lowest risk but also offer the lowest potential returns. Notes represent intermediate term debt issued by governments or corporations, usually with maturities between 1 and 10 years. An example of this are 2-year or 5-year Treasury notes. They provide moderate income and generally experience less price volatility than long term bonds, making them useful for funding medium term goals such as tuition payments within several years. Their risk level is typically considered low to moderate. Finally, bonds are longer term debt securities issued by governments, municipalities, or corporations, and generally mature in 10 to 30 years or more. They pay interest over an extended period and are used to generate higher income than cash or notes while also helping diversify a portfolio against stock market risk. Bonds are often used to help match long term financial liabilities, such as retirement withdrawals. While they still tend to be safer than stocks, their longer maturity exposes them to greater interest rate risk. Together, cash equivalents, notes, and bonds represent different points along the fixed income spectrum, i.e., the yield curve, balancing liquidity, stability, income, and diversification within a well structured portfolio is key. Be mindful that the big money is made in the stock market, not in any of the aforementioned fixed income securities. Okay, next question. A few months ago, you posted a letter you received from Dave Ramsey. Don't many people view him as a hack? I'm sure people believe that, but let's be real. Dave has more money, has a larger following, and has made more positive change than 99% of the people in the financial services industry. I've discussed and have written about where I disagree with Ramsey, but we agree on the big things: getting out of debt, saving and investing, keeping things simple where possible, and giving generously to tzedakah. There are always going to be haters, but the reality is that getting a signed note from anyone who has written over 11 million books is a big win, in my opinion. There's a gentleman in my next question. There's a gentleman in my shul who has been successful in business, and I respect him a lot. He reviewed my finances and said I should be 100% in stocks instead of 80-20 split between stocks and bonds. This made me question my advisor's strategy and ethics. Have I really been inappropriately invested for all this time? Sounds like an asinine suggestion. If this dude is so brilliant and successful, and his big chiddush was to modestly increase your stock exposure, then that's a big nothing burger. First of all, going from an 80-20 stock split to 100% in stocks is not going to change your financial life, I promise. Next, this dude doesn't have any concept of investor psychology. It's very rare that someone can stomach 100% equity. They usually panic at even a slight level of volatility. I can't say for certain that if your portfolio is inappropriately allocated, nor can I offer some suggestions that will actually be useful for you since I don't know you. However, I wouldn't get your knickers in a twist given this Gvir's unhelpful and not insightful suggestion. Hire someone who does this for a living and ask them for an opinion instead of a random dude who has no experience in personal finance. Okay, last question. Is climate change driving inflation? I read that recently in the New York Times. Are you sure the New York Times said that? I'm surprised they didn't blame Israel for inflation. That, that being said, let me rephrase your hypothesis. Changing weather patterns are causing the rate at which the level of prices for goods and services rise across an economy over time, thereby reducing the purchasing power of money. Does that seem logical to you? It shouldn't seem logical because it's not. Although Tucker Carlson actually came out recently with a study on who is causing inflation, he discovered that it was caused by someone named El Nino. Turns out Mr. El Nino was spotted at Chabad. Chabad is a Jewish organization. Furthermore, the Third Temple needs warmer temperatures in order to be built. Coincidence? I think not. I'm joking, by the way. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me. And perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I would like to end with a timely and actual idea that listeners can implement to their own financial lives. Today's timely idea is continuing along the same theme for the past several weeks, which is tax traps to avoid. In particular, we'll discuss the scenario where you're pulling money from the wrong account first. Most retirees draw down whichever account feels easiest to tap rather than the one that's most tax efficient. Spend down a $500,000 taxable account too fast in your 60s, for instance, and you may enter your 70s relying heavily on a traditional IRA withdrawals, just as RMDs force even more income out at the same time, pushing that what could have been a 22% bracket that year into a 24% bracket. Leave your Roth untouched until you don't need it, and you waste years of tax free growth it could have provided. The right order depends on your brackets, balances, and timeline, but it's worth building a multi year withdrawal plan rather than deciding year by year. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. To spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.